recording on Tuesday afternoon, June the 12th. I'll go through this as quickly as I can, but we do have a lot of information to cover. There weren't any major surprises in the markets or in the report today, but nevertheless, there's a lot happening in the markets that I want to talk about. To begin with, the corn carryover estimate for 17-18 was dropped from 2.293 billion bushels down to 2.1. The U.S. corn carryover for 18-19 was lowered from 1.68 to 1.577. So, some friendly numbers here in the carryover. New crop estimates take nothing into consideration, though, for growing conditions and better yields. So, what this report really establishes today is that weather and yield is now everything when it comes to the corn crop and also for the soybean crop. Soybean carryover for 17-18 was estimated at 505 million bushels, and 18-19 at 385 million bushels. As in corn, this again does not take into consideration the crop was planted early, and we've had great growing conditions since it went in the ground. World corn carryout for 18-19 was lowered from the previous estimate of 159.15 down to 154.69. This is a critical number, and I'm going to spend more time on this later because we're really seeing a drawdown in world corn carryover stocks, which is starting to make us lean a little bit more towards the friendly side of corn, even though we've been very bearish for the last 10 days. World soybean carryout for 18-19 was increased from 86.7 to 87, kind of a nothing there. Wheat carryover, these numbers are really nothing surprising, nothing really bullish or really bearish in the wheat numbers. World wheat carryover 18-19 increased from 264 to 266. Again, not a game changer. Cotton carryover for 17-18 estimated at 4.2 million bales. 18-19 lowered from the previous estimate of 5.2 to 4.7. That's a pretty significant drop, and the cotton market responded positively to that today. And world cotton carryover was changed only slightly from an estimate of 83.75 million bales, it should be bales and not hundredweights, to 83.02. It was 88.21 million bales in 2017-18. So make that correction, the CWTs. In the world corn ending stocks, here this is the table. Again, for the U.S. We're at 2.102 billion bushels. The world's at 192.67. You'll see that a year ago we were at 227.9. So that's a fairly significant change. When we take a look at for 18-19, that 192 drops all the way down to 154.7. Again, a very significant change from where we were 3 or 4 years ago. The U.S. carryout, tighter than what we've been. We're now at 15.77 for 18-19, that's their estimate. And for this year, they're at 2.102. So on the surface, it appears to be a pretty friendly number. But again, it all depends on this year's yield. Argentine crop came in a little higher than expected. The Brazil crop also came in a little bit higher than expected at 85 million metric tons. So now let's take a look at the crop condition as of this weekend, and you can see the average is the dash line. We're at 77 right now percent on the good to excellent rating. That's obviously the highest we've been in many years. As we take a look at the corn by state, with the light colors being 18 and the dark colors being the 5-year average, you can see in the key states, Iowa, good to excellent rating, well above the 5-year average. Illinois, Nebraska, Minnesota, and Indiana, all well above the 5-year average. Then you get to South Dakota, is not, it's well below the 5-year average. Kansas, you take Ohio well above, Wisconsin well above. So overall, it balances out pretty well. Your largest producing states are in the best conditions they have ever been. Now, this is kind of interesting. The star represents where we're at right now on the good to excellent ratings in week number 24. And basically what this tells you is, based on historical relationships, if we're at this level, on week 24, history would tell you that the national average yield will be 5% above the normal trend line yield. Weather conditions, drought monitor, obviously the Southwest is in big trouble now compared to where they were a year ago. Midwest, there's some dry areas here, as you can see, in northern Iowa, and it's getting over into central Illinois now as well. So there's some pockets of dryness, but the 7-day precip map is pretty wet. We take a look at the temp maps. The 6 to 10 days says the central part of the Midwest is supposed to be hot and with normal precip. The 8 to 14 day is still warm to hot and still pretty normal precip to above normal precip. The southern part of the U.S. and the western part of the U.S., where a lot of the drought is supposed to start getting above normal precip. So now let's start taking apart the balance sheet in corn, see where we're at. This column represents the changes the USDA made today from the 17-18 crop. You see it really wasn't hardly any. Increased usage by increasing the exports by 75 million bushels. So that brings a carryover into this year to the 18-19 at 2.1. But if we look more closely at this number, our carryover for 17-18, which is the year we're in, this is the old crop. And we're going to pretty much match the USDA at this point. You're looking at an expected average price of $320 to $350. The market has been well above there for quite some period of time. So fundamentally, the market was overpriced. The key number right now is we take a look at planted acreage. The USDA is using 88 million. We're at 88.5. They're using a 174 yield. It would take some severe drought conditions, we think, in order to get the yield down to that, because in 17-18 our yield was 176.6. So we're putting in a yield just slightly below where we were last year, which with today's crop conditions would not seem to be correct. It should be higher than that. Could easily be 178 or 180, but let's just use the 176. And what happens is we come down here, our feed usage, we're going to drop slightly to 5.4 billion bushels. Ethanol usage is pretty stable. We're going to call that 5.6. And exports, almost everyone in the industry thinks will drop off slightly this coming year. And that would leave us then with a carryover of 1.776 billion bushels. Stocks to usage ratio of 12.1%. And we're looking at an expected average price in that 350 to 430 range. Take a look at what happens here if you increase the yield just to 178. Now, 2 times 81.1 million acres, that adds 160 million bushels to the carryover. So then you're back over 2 billion bushel carryover. So again, I just want to emphasize how important our yields are going forward. It's a graphic representation of the carryover supply in corn. Again, we'll be at the lowest this coming year in 3 years. If you take a stocks to usage ratio, again, for the 18-19 crop, I mentioned it was probably going to be about 12.1%. You come up here to your price curve, come over here to your expected average price. It comes in at $4, and that would be basically a Central Illinois corn price, which is 30 under the board. And so, you know, this market is not, after the sell-off of the last 2 weeks, is not overpriced at this level. Corn exports have been very good. We're well above where we need to be to meet the USDA's expected forecast there of slightly above 2.25 billion bushels. We're obviously way above the 5-year average and slightly above now the 16-17 export pace. Take a look at the world market. Okay, our corn production in 18-19 is expected to be down 300, now going from bushels to metric tons, 356 versus this past year 371. But China is up 225 versus 215. Brazil's up quite a bit, 96 million to 85 million metric tons. Go down, Argentina up a lot as well. So we take a look at the world as a whole. Even though carryover is coming down, production is going to be fairly significantly higher in 2018-19 marketing season and then 17-18. Here's another way of looking at it. We take a look at the carryovers here, 154 versus 192, 227, and so this is the lowest number we've been since the 2012 and 2013 marketing year world corn. Again, graphic representation of looking at it. I think what's impressive here and what's got us concerned is if you look at the stocks to usage ratio right now in the world market, this is the lowest we've been since about 1975-76. And so some of you would say, then why isn't this market going through the roof? Well, because the reality is we still have a lot of corn right now, and it's not needed now. It could be in a year from now, and it all depends on this year's yield. On the monthly chart, you can see we're locked into a sideways trading range. Now, let's take a quick look at the decision-making part of this market. You know, here's where we were in January, and as all of you know, we turned quite friendly to the corn market back in January, and then we started making sales in this area here over the last 6 weeks. This has been a tough market in through here. It's been pretty much trendless. And going into all of this, find my numbers here, we just had very little sold. I think we sold 10% for hedgers somewhere in here. I can't remember the exact day. And we put on a 20% hedge, came out of had a heavier hedge than that, came out part of it here at about break even. But the key decision-making day here in corn was the day after Memorial Day, that Tuesday. As you can see right here, we have it marked. It was a key reversal down. When, you know, you've heard us say this many times in the past, and you've heard it from other people in the business, that 3-day weekends typically are either turning points or acceleration legs. And in this case, we're already in a bull market. And so if this market was going to stay solid, we needed to accelerate that Tuesday, and we did not. The drought that had been forecast that had been supporting this market for the previous 3 weeks dissipated, and the weather conditions were not near as hot and dry as expected. We had a key reversal down, and so on that close that day, we went to 90% sold in old crop corn and just holding back 10%. Now that brings us in today. I mean, yesterday we closed at new lows for the move right here. The report was somewhat friendly, and we closed up 8 or 9 cents here, but we did not close above yesterday's high. So if that would have happened, we would have been a little more excited. But right now, today's action doesn't really tell us a lot of anything. But again, we're 90% sold. This is a market that we're holding 10% back for sales, only for weather insurance in case something really happens bad in July. We've got a little bit of corn left. But your target now is this gap that was left on the way down last week, and in July corn that's at about 390. So if you're looking for a place to do catch-up sales, 390 is your magic number. You get up into that gap area, then we'd start doing some catch-up sales. Now this is a great chart and it's been very helpful. You can see the 5-wave down pattern, 1, 2, 3, 4, and 5. The 5-wave sell signal was given right here. Again, this is the day after Memorial Day weekend, and we also had a key reversal down. We jumped all over the market that day. We've written about it quite a bit since then. It was definitely a decision-making day. And the reason it's a decision-making day, and again, I hate sounding like a broken record, but you make decisions in markets when you know what your risk is of being wrong. If you have a key reversal down after an extended bull market like we had since January, then you have that day. If you do it with hedges and futures, your risk is a close above that day's high. So if you sell the dickens out of it here, your risk is a move from here to here. And that seems only logical. I want to know where it is we're going to be wrong. So we're going to take an aggressive position in a market like this. If you wait for a week to see if it's right and say sell it right here, your risk is still a close above there. So all of a sudden, your risk in the position is now double. If you wait until this week, it's now triple. And so you have to make the decision when the market says to make the decision. You can't just wait and see if it's right. Then your risk goes up. So now we go into today, and we, at that point in time right here, we put on a 30% hedge, taking us to 50% 40% hedged in the futures, and we have a 10% cash market on. So as this market collapsed in the last 10 days, we've been 50% priced and 90% in the old crop. Now today we got some support. Now we have, if you can envision this, where the 2 is on this wave, that the 2 becomes a 1, 3 becomes 2, 4 becomes 3, 5 becomes 4, and we're now in a 5th wave down, and your buy signal is a close above the high of the lowest day of the move, which we didn't get today. So I hate to sound like a broken record. We've been very bearish. This hedge has made a lot of money. It's been very profitable. We don't want to let that get away. If we're higher tomorrow, we're probably going to come out of these hedges, or at least lighten up. So tomorrow's really crucial right now. With today's stronger markets, we have to have follow through to the upside if this is going to go higher. We need it now. Otherwise, we're not going anywhere. So and we may just come out of half of it, but be sure to check in with us tomorrow. All right, now let's turn our attention. Well, before I forget, then on corn buying needs, we're not recommending anything yet. If we're stronger tomorrow, we will recommend livestock buyers to be buying some more corn. Soybeans, estimated carrier 1718 now, 505. Last year it was 302. In the world, 92.5 million metric tons. In the prior year it was 97.4. Now, more important as we take a look at the 1819 crop. We do not agree with this number at all, as I'll show you later. There are 385 million bushel carryover for this coming year. This year's at 505. The world's at 87 million metric tons. Prior year, 92.5. All right, now we look at 1718 in Brazil and Argentina. Argentina this past year hurt significantly by the drought, 37 versus 57 million metric tons. Brazil up slightly, 119 versus 114.6. We take a look at the Brazil and Argentina production combined. As you can see, yeah, because of the drought in Argentina, they're down somewhat this year, but overall production is very strong. We take a look at the soybean crop condition, highest in history right now, good to excellent. This early season, that doesn't necessarily mean anything, but it certainly is not bullish right now. We take a look at the state-by-state breakdown, again, like in corn. Illinois is way ahead of the 5-year average. Iowa, Minnesota, Nebraska, Indiana. Look at Ohio, substantially above the 5-year average. States that have got some issues, South Dakota, well below the 5-year average. Missouri is also well below the 5-year average. The good to excellent rating in soybeans, we're right here this year, one of the highest we've ever had in history. And like in corn, that would indicate that we should have a 5 to 6% increase in trend line above the trend yield. So let's rip apart the supply-demand balance table now. I think 1718 now is pretty much a given, right or wrong. I think this 505 is a little bit on the low side, but we had been at 514. If you look back in the Brock report, at this stage of the year, we'll just go with what the USDA has. I mean, not much is going to change now. Put it at 505 with an average price of 940. So now let's look at the important numbers. USDA is still saying that U.S. farmers only planted 89 million acres. We think that is wrong. The feedback we get from subscribers and clients, I think we're on the conservative side at 90 million acres. They're using right now what I think is a ridiculously low yield of 48.5, and I think ours is low at 49.1, same as last year's. But let's leave it at that. And as you go through all these numbers, you look at exports and crush and everything else, all of a sudden we come up with a carryover of 489 million versus their 385. Put a yield, you can play with these numbers yourself. Put a yield on here of 50.1, so you're adding 89 million to the production side, and you take that to the carryover, and all of a sudden you're up to carryover 570 million bushels. I mean, this thing could change substantially, and that is a much different number than the USDA's got at 385. With the way the market acted today, I think more people are believing our numbers than the USDA's numbers, because that 385 should have been a bullish number, and it is not. We had a negative reaction today to what should have been a bullish reaction, and that's not a good sign. We take a look at soybean exports. They're doing quite well. China has temporarily quit buying our beans. I think we'll get that mess straightened out. They need our beans. We need their business. This is a win-win deal for everybody. We take a look at crush. We had record crush in the first quarter of this year. Crushing margins were very, very strong, and so processors really ramped up. Now we're seeing a seasonal decline in crush, and we've got to build up the soybean meal supplies. It's a graphic representation of U.S. carryover supplies. You can see these are big numbers in the beans. Totally opposite situation from corn. I'm going to go back. Well, we have the numbers right here. For 17-18, stocks to usage ratio is 12.2%, and 18-19 is 11%. Realistically, if we come up here to our price curve, and we're just afraid to put this in print, history tells you we should be averaging closer to $8 on new crop beans. So when we were hedging these beans aggressively at 10.5, we didn't see any problem with that from a fundamental point of view. This market was grossly overpriced. We're just afraid to put this in print that this market could go this low. But if we plant the acres that we think we're going to plant and have above normal trendline yields, then this market is still overpriced. So we take a look at Brazil's production at 119 million metric tons for 17-18, 118 for 18-19. Argentina is expected to bounce back big. This is their big problem with the drought this year, and this is what the USDA is forecasting now for 18-19. So they're going to bounce back. And in the world, though, the world carryover number estimated for 18-19 at 87.02, 82. But you can see still we're down from the last 2 years, but based upon the last 10 years, this is a pretty big number in the carryover supply. And this graphically shows it. We've got some big carryover supplies in soybeans. Here's a monthly chart in beans. Here's a daily chart through today. Again, we closed just a few ticks higher today, near the lows of the day. This is one of those days, or one of those markets that if you didn't sell it when it said to sell it, it was hard to get back on board. We went 100% sold in beans. I was somewhere right in here. I can't remember the exact day. I don't even want to think about old crop beans. They're long gone in our opinion. But let me go through the new crop beans scenario. We're 80% priced now for hedgers. We are sitting at 40% priced for strict cash marketers. Of the 80% for hedgers, 30% was sold in the cash market. I can't remember the exact day, but it was somewhere in here. We made those forward cash contracts. This had a classic technical top, a 1, 2, 3, 4, 5. You sell the market in the first close below the low of the highest day. Again, here we go into Tuesday following the Memorial Day weekend. Everybody was bulled up going into that weekend. Weather forecasters saying it wasn't going to rain for the rest of our lives. And, who knows how bullish this was going to get. And, there were people in the coffee shops that were talking $14 beans and $5 corn again. All right, we come in with the key reversal down. We put 30% hedges on right here, and we're still there now. Needless to say, this has been a home run pitch. This market has virtually collapsed since we put all those hedges on and went to 80% priced. Again, after 42 years of doing this, I think this was the easiest decision we ever made. And yet I know that a lot of producers who follow us and are listening to this now had trouble doing it because you wanted to listen to the bullish news in the coffee shop. You wanted this market to go higher. But, when you get that kind of a technical signal, you got to ignore the coffee shop. You have to ignore what you want. That market was screaming to sell it. And again, the risk then was a close above that Thursday's high. And again, we're looking at 1050 beans. The market has a significant potential of averaging $9 or less if we have decent growing weather. So this, unlike corn, this is a market that was just grossly overpriced based upon the known fundamentals. And then you get the technical signal. And then today we close 1 or 2 higher after the bullish turnaround. And so now people are hoping it stops right here. This support line means nothing to me. I don't see that there right now. This market is in a free fall. It reminds me so much of the corn market in March of 2013 when it gave a sell signal, and then it just doesn't give a person a chance to get on board. If you don't do it quickly and you wait and so well, wait for a bounce, you wait for a bounce, you wait for a bounce, and it keeps going down and down, and then people just tune it out and say, well, the heck with it, I'm not going to make a decision at all, which gets you up to today. And if you're not at our recommended levels today, this is a tough market. I would say this. Right now, we have no intentions of coming out of these hedges because there's nothing here that looks like a bottom to me. And I think we're still in a free fall, and I think a lot of people are caught. I mean, think about this. Anyone who went long soybeans speculatively all through this time frame, I'm talking a big time frame, all have big losses in those positions right now. Do you think this market's going to allow them to be bailed out? I don't think so. I think this is a market that's going to squeeze these people until they run out of money, and I don't think they're out of money yet. And so this is a classic bear market, and you'll know when the bottom's in when you see it, and right now we don't see it. So just stay short. Needless to say, for those of you that are buying soybean meal, no need to be buying this thing. Bear spreads are working, trends down. Probably your stopping points this area down here at 320. It's another $35. $35 a ton down. And then to add insult to injury today, look what soybean oil did today. Big outside day down. New contract low closes today in the soybean oil. So for those who want to be bullish, I'm sorry, I can't agree. This is a substantial bear market, and we haven't seen it yet, and now it's a function of hanging on. Hard red winter wheat production is 650 million bushels. A year ago was 750. Take a look at all wheat, 1.827. A year ago, 1.741. So that number is a little negative. But then we take a look at world wheat ending stocks and the U.S. World's at 272, and this is 255. So these numbers, supply demand wise, you would think are quite bearish. And yet the market was up almost 20 cents today. We take a look at U.S. and world wheat ending stocks for 1819. This is the good news. It's starting to decline. 266 versus this year's 272. And then we're at 946 versus 1.08 here in the U.S. This is a graphic representation of the condition index. You can see right now, overall, we in 2018, here's 15, 17, 12, 16. We're not in real good shape. And particularly when you look at the key states, you got Kansas here, 21% of the winter wheat production, is produced in Kansas. That's down 7.5 points from the 5-year average. Look at Oklahoma, not in good shape. But then you look at some of the other states, although they're not near as big on the production side as Kansas, their wheat conditions are much better. There's another graphic way of looking at the wheat conditions. And again, Kansas on the far left there is not in real good shape. Spring wheat condition, though, is not bad. The average is at 67.8%, good to excellent, and we're at 70. So overall, that one's in pretty good shape. So we look at a balance sheet without spending a lot of time on this. We're expecting this year's carryover at 933 million bushels, 17-18 at 1.086. And so, numbers getting a little bit friendlier, but you look at your stocks to usage ratio, it's still at 44.4%. Exports, pretty miserable. We take a look at the world market coming down in carryover, estimated for 2018-19 at 266, 272 this year. That's down from last year, but still well above where we've been previous 5 years. Here is a monthly wheat chart. So now just kind of forget what I just said about the fundamentals being, well, I think they're just mixed. I can't take a strong argument on either the bull or bear side. I look at this chart and say the trend is up, the trend is your friend. I take a look at July Chicago wheat. It had an outside day up today off of a major support line. You take a look at July Kansas City wheat, it did the same thing. We have a light option strategy on this market, long some December Chicago wheat puts and short some out of the money calls. Not likely we're going to get stung on those positions. They're about where we put them on right now. Go back to this, but right now, the fact of the matter is the trend in this market is up. I think basis levels are extremely tight. And there's two ways of looking at it. So if the basis is tight, sell it. I don't want to do that when the market is in an uptrend, because all that tells me is if someone really wants to buy our wheat, basis levels get strong in an uptrend, you sit back and wait in this market. You don't do anything. Cotton market, again, USDA estimating the 18-19 carryover at 5.09 million bales. That's our estimate. The USDA is over here at 4.7. So we're quite a bit different than the USDA, and most of it has to do with yield. We're at 860 pounds, they're at 841, and so a mixed indicator there. The good to excellent, as you can see, is at 42%, well below the average. We take a look at the state-by-state breakdown. The biggest problem here, really, Texas, major producer, and you get into the panhandle of Texas right now, crop is not in good condition. Arkansas is good, California is good, Georgia's okay. And then you got some states like Oklahoma that are really sad shape because of the dry weather. And just like we showed you earlier on the good to excellent ratings for corn and soybeans that were very good. Cotton is only at, 42% good to excellent, and that tells you historically the national average yield should be probably about 2 or 3 percentage points below the trend yield. Export commitments have been very good. Asian countries have been very strong buyers. We're way above every year that we've been at this level, and so the demand side is very positive. Ending stocks are high, but certainly not overly burdensome. We take a look at the world carryovers, 83.02, 88 starting to decline. As you can see, it's a mixed bag compared to the last 10 years, and easier to look at it on a graph like this. Yeah, they're big numbers, but we have bigger numbers in the carryover. Monthly futures trend is up. July futures trend is up. December futures trend is up. Currently, we're sitting with a 20% short hedge on in December cotton. We had a key reversal down right here, and we sold it on that close, and we saw that 20% on, so it's a very small loss on the hedge. We close above this level up here. We'll head for the hills, break out the upside. But right now, this is an inconclusive market because based on the fundamentals, 94 cent cotton is high-priced cotton. So we really would prefer to be looking for a place to sell it. Rice, ending carryover, we're estimating right now 44 million hundredweights. Last year was 37.3. USDA is at 41.5 and 37.3 respectively. So we're looking, say, at an expected average price this coming year of just slice it in the middle would be about $12, and slightly higher than that for this year. Rice condition is well above the average. Ending stocks are high. World stocks about the same as a year ago, but well above 2 years ago when they were at 136.74 million hundredweights. Now we take a look at July cotton chart. You see we had a key reversal, a rice chart, I'm sorry, a key reversal up last week right here. If I can draw my line straight, and we had follow through today. So this market, even though it dropped sharply over the last 3 weeks, it's now coming back. As far as we're concerned, this market has a confirmed bottom in it. So taking a look at all of this, price action in corn, we think today was neutral or friendly. Be prepared to listen to our tape tomorrow and view our recommendations. I think we could have some. Next couple of days is going to be very important because after this sell-off, if we don't get follow through the downside, we get follow through to the upside again tomorrow instead, then we're going to be looking for a place to take profit on these hedges. And I just don't like giving big profits back. So the price action day in soybeans, though, I think is very negative. I don't like a market that acts this way over what could have been very positive news. Granted, the market's extremely oversold, But I think a lot of speculators are caught in this market. I think the funds are caught in this market long, and I think we have to liquidate more of those folks before this market can turn around. Ideally, what I'd like to see happen, I'd like to see soybeans drop another 50 to 75 cents here real quickly. We are aggressive on the hedge side. Let us put this hedge money in the bank and then sit and ride this thing up into the harvest time. That would be the best thing for all of us if that were to happen. But market doesn't always satisfy all of our wishes. Price action in wheat, I think today was very bullish. I don't want to be bearish in a market that had outside days up, and this one was pretty strong. Cotton, I think, was neutral or friendly, but it didn't take out yesterday's high. So be prepared. We have a light hedge on there. We'll probably be taking profits or taking a small loss on it if it does go in to new highs. So, yeah, I hate to sound like a two-armed economist and talk out of both sides of my mouth, but everything depends on the weather now here in the next 6 weeks. I think more important than ever. Other issues we need to be faced with is the tariff arguments, China's threats, Mexico's threats, Canada's threats. It's interesting. These markets aren't reacting really negatively to any of these tariff threats. It's so the market thinks everything's going to get worked out because we all need one another. And I think need is a driving force in these kinds of negotiations. We can't get by without these other countries, particularly in agriculture when it comes to Canada, Mexico, and China. And then you take a look at, and we didn't throw it in here this time, but the Chinese carryover in corn has been dropping like a rock. I wrote these numbers down. It is now estimated that the carryover in corn for China at the end of the 18-19 growing season is going to be 60.5 million metric tons. This year it's 79.55, and in 16-17 it was 100.7. So in 2 years' time, China is drawing down their carryover supplies by 40%. Now, you're going to be hearing a lot of other people in this business saying that's all really bullish. And if it keeps this direction, it is. But the market already knows this information too. So it's only bullish if the market reacts positively to this news. And as of right now, I think it's a cautionary flag. It means we need to be watching everything very closely. I think 2-3 years down the road, these are very bullish arguments. But we're trying to make decisions here in the next month, not 3 years down the road. And so be careful. Don't make short-term decisions on long-term fundamentals and vice versa. And so, we've got to look at the information we have in hand. And just always remember, when you're looking at all these changes in the fundamentals, the trend is your friend. Look at the chart. That is what summarizes what everyone is thinking fundamentally in a market in one snapshot. So as long as you know the technical rules, you'll do very well in these markets. And if you ignore the coffee shop talk and just look at the trends, you're going to be just absolutely fine. It's treated us really well here in the last 12 months, and it kept us bullish in these markets in the first 5 months, and resulted in us getting very bearish on Memorial Day weekend. So I'm confident that this is all going to work out just fine. We've added some new consultants to help serve you better. If you look through these pages of our consultants here, Mark Heckman is new in Iowa. Charlie Stutzman is new in Michigan, and Alan Assman in Omaha, Nebraska now has joined us. So we have some new consultants, and then of course we've got a lot of people here that have been with us for 35, 40 years. So anyway, it's a fun time. A lot of things changing. The mergers and acquisitions are hopefully coming to a close right now, and so we just look forward to the growing season. This coming week, our seminars will be in Grand Island on Monday. Let's see, Sioux Falls, South Dakota on Tuesday, Mankato on Wednesday. Then the following week, we start on Monday in Lafayette, Indiana, Tuesday. I think we're in we're in Bloomington, Illinois, and then Wednesday in Ames, Iowa. So try to get there. We have a lot of people signed up already for those meetings. There'll be half-day meetings in the afternoons, and it's always an educational experience for all of us. So that's all I have for today, and I hope to see you at one of those meetings.